Welcome to Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services in Eastland, Texas. Tune in every week as we share important information to help you and your family live life on purpose. Insurance, investments, legacy and tax planning, and much more. All covered now on Life Planning 101.
Welcome into Life Planning 101. My name is Angela Robinson with Smart Money Group and Kennedy Financial Services in the big town of Eastland, Texas, talking about the One Big Beautiful Bill Act for a second week in a row. Our extensive glance. Yes, like I said before, that's not an oxymoron. We are looking at it at a glance. When it's a 1,000-page bill, it takes some time, and we are on part 2 of this glance. So if you missed last week, you're definitely want to go back. So go to our website, www.kennedy-financial.com. Make sure you're subscribed to our weekly life lessons newsletter that comes out. It has the black and white market chatter. We have, and by the way, we have this One Big Beautiful Bill Act extensive glance in written form, nice little tables, easy to find things in there if you're looking for something specific. So that's good. And then obviously you can go on all the major podcast networks, iHeartRadio, Spotify, etc. Like us, follow us, make us your favorite. Life Planning 101. And so that way you can listen to last week's show because it was really good. And we walked through some of what I suspect is my favorite part is just permanence and stability that we were given, if there is such a thing in Washington, like I say. But there were some things that we did get some permanence and stability out of to be able to help people plan for their futures. And we talked also through state and local taxes. We also talked through some things that need your immediate attention. So make sure and go back and visit those. Today we're going to hit another slew of things. So we have some student-focused items. We have some charitable gifting items. We have some new tax legislation for individuals. And we have some new tax legislation for businesses. And I say businesses / farmers and ranchers. There is a lot to cover here. Again, 1,000-page bill. So we're not going to deep dive into anything. This is really just to give you a big picture glance so that you can start inquiring about things that might impact you. I will remind you too, we are not your tax professional. We are not your accountant, your CPA, your tax attorney. We are simply planners. And so our job is to read this nasty 1,000-page bill and put it in some type of format that gives you enough information to be asking questions. And of course, we're here to help you solidify and make sure you're asking the right questions. So let's jump in. Let's talk about those kids. There was quite a bit of student focus inside the One Big Beautiful Bill Act. 529s got a huge expansion. So 529s are, typical instrument that you are able to put money back into. Dollars grow tax deferred, and as long as your children used them for educational expenses, they would come out without any taxation. And there's been a lot of change in recent years as to schooling and what that actually looks like. So this was great to see that they expanded the language to be able to use the funds towards connections with elementary, secondary schooling, tutoring, homeschooling, special needs therapies, as well as additional higher educational expenses like credentialing and vocational training. So very, very good. I love that one. While we're on the topic of students here, I want to talk about student loans. So these were hit pretty hard. Lots of changes to this. I say lots of changes, some significant changes with the student loans. They created a cap, a borrowing cap. It's a lifetime borrowing cap of a student. Graduates have $100,000 on that cap. Medical and law students have a $200,000 cap. And there's also further limitations for part-time students. And there's a cap on the Parent Plus loans now of $65,000. Repayment options for loans were absolutely gutted and simplified to just 2 options. So repayment plans, you either have a 10 to 20 year repayment plan regardless of your income, Or you can use what they call the repayment assistance plan, which is going to be 1 to 10% of your discretionary income. Here's the other thing. The Parent Plus loans won't be eligible for the repayment plan program. So they're just the traditional loans. So make sure you find out what you need to know there. I do believe there were some changes as well with what it takes to qualify for these loans and what counts against you, what doesn't. So if you're at that age where you're working with someone now for financial aid, it'd be a good idea to set up a meeting and really learn what you don't know, what you need to know, make good, solid plans about your future in regard to those student loans. Let's jump into Trump accounts. So yes, that is their name, Trump accounts, and it is a new type of account for children under the age of 8. That's who can open it. And it can support contributions from anyone at a maximum of $5,000 per year for the beneficiary until they turn 18. So here's the other thing. Employers can also make contributions for the child of an employee without being taxable to the employee. Pretty cool. Great way to get some added benefits for your employees. Trump accounts also grow tax deferred, kind of like the 529, but they actually look a little bit more like an IRA as I look through them. They have preferential tax treatment for the beneficiary if they use it for education or for first-time home purchases, or capital for a small business or farm. So there's some expansion here with the Trump accounts that's not allowed with the 529 accounts. And those preferential tax treatments, I think, is taxed as capital gains, which if you look at a person under the age of 30, that might be like a tax-free, but if you don't use it for that, then it's taxed as ordinary income rates. And I believe there's a penalty on top of that. But they must be emptied out by the time that the beneficiary is 30 years old. And in addition to all of this, there's a pilot program in the years 2025 through 2028. Babies born within those years get a one-time deposit from the government for $1,000. Pretty nice. So some really good things with our kids that are focused on that. Let's switch to charitable gifting. There's some good and bad here. So let's just talk about that universal. There's number one, there's now what's called a universal charitable deduction. And I do like this because they've gotten the standard deduction amounts so high. In fact, they increased them again in this bill, that most people are not able to deduct their charitable gifts on an annual basis, or it just doesn't make sense to. So now, if you are gifting charitably, even if you don't itemize, if you take the standard deduction, you can receive $1,000 if you're filing as an individual and $2,000 if you're filing jointly, as an additional charitable deduction, which is great. Additionally, there's now tax credits for scholarships. This is pretty cool. So this goes only through the end of 2029. I don't know why, but there's a new credit for up to $5,000 or 10% of your adjusted gross income, whichever is greater, for contributions to state-approved scholarship granting organizations. That's absolutely wonderful. So the way I look at that is like if you owed $5,000 of tax and you gifted $5,000 to a state-approved scholarship granting organization, then virtually your tax credit will pay for that scholarship. So that's pretty cool. That's really cool. But then comes the bad news. We now have floors established for the ability to itemize charitable gifts for individuals and corporations, respectively here. So yes, they raised the standard deduction, made it harder for us to even get those charitable write-offs, and now we got a floor on top of that. So it's a 0.5% floor against your income that you have to hit before you start being able to deduct those charitable gifts. And if you're a corporation, it's a 1% floor. Now, you can carry these forward. I believe it's up to 5 years for both. You gotta question that. That's a good question on the corporation side. But just knowing that those floors exist, because it's not as easy as it once was to calculate what your charitable deductions are going to look like. So there's your kids. There's your charitable deductions. we're going to switch gears and we're going to talk about some new legislation. Actually, we've been talking about new legislation if you think about it, but this is new legislation focused on the individual tax return. So we're on the topic of over our itemized deductions. Let's just stay on it. So in addition to all of this, now your overall itemized deductions are limited if you're in the top tax bracket. Yes. So rather than being able to just deduct those itemized deductions against your top income level, now you're only able to take those against your next. Remember, we're in a progressive tax system, right? So your 37% your highest, 35%. So you're only able to deduct those at a 35% rate. So you lose 2% on that deduction in essence. I hope that makes sense. So if I had like $100,000 of itemized deductions and I was in the 37% bracket, last year I was able to obtain a $37,000 write-off for those deductions. This year I would only be able to obtain a $35,000 benefit there. Then let's get into the stuff that was just so talked about over these last several months. No tax on tips, no tax on some overtime. And here's the deal. It's not no tax on tips and it's not no tax on overtime. It's no tax on some tips. It's no tax on some overtime. And oh, by the way, no tax on some Social Security. These all kind of work the same way. So there's an above the line exemption of $25,000 for qualified tips, which means that you don't have to itemize your deductions to take it. And it means that it goes like, so if your income was $150,000, you had $25,000 of tips, then it would be reduced. You get a deduction. In that income, you had $25,000 of tips, and you get to reduce it by the $25,000 at that point. It starts to phase out. That deduction starts to phase out if you do make $150,000, or if you're married filing jointly, it starts to phase out at $300,000. Okay, this works the same way with overtime. It's no tax on some overtime, but it's not as gracious as the tips. I guess they think that most people work off of their tips, make more off of their tips. On the overtime, you only have an exemption of $12,500. And there's another little caveat in this that you need to know about. It needs to be reported separately on your W-2. If it's not reported separately on your W-2, then it's not classified as overtime, so you don't get the deduction. And oh, by the way, both of these clauses are only eligible for 3 years. 2025, I guess it would be 4 years. 2025, 2026, 2027, 2028. So, yes, it's not quite what the big hoopla was about. It's no tax on some tips, and it's no tax on some overtime. Now, let's take a look at no tax on some Social Security. So this was a big deal, no tax on Social Security. Well, according to the White House, and that they are planning that this will affect, I think, it was like above 80% of seniors. So that was their guesstimate. I forget what the actual number was, but it was above 80%. They expected it to be able to positively affect. However, it's not as good as it sounded to begin with. It's actually more of like a senior deduction, whether or not you're taking Social Security, because it's available for those over age 65, and it's $6,000. Okay, so anyone over 65 has a $6,000 senior deduction, unless your income is too high. And then it starts phasing out, because if your income starts at $75,000 for individuals, or $150,000 if you're married filing jointly, that deduction starts to go deet and ratchet down. So it's important to know that if you're planning around any of these areas, no tax on tips, no tax on overtime, no tax on Social Security, you actually know what this looks like on your tax bill. It's not what it seems. Now, let's jump into new tax legislation for businesses. And I'm going to hit these pretty quick, because I think what I want to do is I want to go back. I want to spend some time in some of these areas in a future show, just simply because there's just good stuff here. We talked about earlier in last episode about being able to have that 100% depreciation and bonus depreciation 1 year, and increasing the limits around that section 179 expensing up to $2.5 million. In addition to that, there is actually certain qualified property if it's used for qualified manufacturing, agriculture, chemical production, or refining of a qualified product that you can expense in 1 year at 100%. Now, there's recapture rules, and they're pretty strong, 10 years, so you need to be careful with that long-term planning, but this opens a door that we've not seen before for qualified property. Pretty cool. Let's talk about conservation easements for a second. This was a big thing. We're working with people, and obviously it was a big scare. Is the funding going to be there specifically for farmers and ranchers? Well, good news is environmental quality incentives programs, conservation steward program, the agriculture conservation easement program, they've all been funded through 2031, which is great. The Inflation Reduction Act funding was actually redirected to put into these permanent farm bill baselines. And so it actually increased the funding for these particular programs. And then there's renewal with funding that wasn't there before. There wasn't funding. There was renewal, but there wasn't funding through 2031 for some other small initiatives, which are things like well water through the Grassroots Source Water Protection Program. There's another one about incentivizing farmers and ranchers to open their land for hunting and recreation through voluntary public access and habitat incentive program. And Texans, you're going to be really, really happy. There's a feral swine eradication and control pilot program. And this is an initiative to help offset the damages caused by those nasty little wild pigs that run around everywhere. So that was really good to hear. More on farm and ranch for just a second. There is $66 billion in new spending for farm programs in this bill. It is the largest infusion since 2002. It includes commodity programs, crop insurance, conservation programs that we mentioned earlier, trade promotion, research and innovation, education, rural development, energy programs, support for specialty crops, nutrition, and miscellaneous farm and livestock provisions. So get yourself educated. Find out what's available for you to be able to tap into. Lots of good stuff. And I want to end on one that, again, I intend to do some deeper diving on some of these things, and that's the qualified small business stock exemption expansion. This was put in place years ago, actually expanded upon in the Obama administration. Pretty cool, where you could exempt $10 million of capital gains if you had converted to a qualified small business with stock as a C corporation and held that for 5 years, and you had all the qualifying features. There's lots of rules and regulations, but you could exempt up to $10 million of gains in that stock, or 10 times your basis, whichever was greater, when you go to sell that stock down the road. Very beneficial for small business owners to be able to exit their businesses efficiently. Well, they've expanded this rule. Now, rather than having to wait that 5 years, the holding period is 3 years. And at 3 years, 50% of the gains are not taxed. At 4 years, 75% of the gains are not taxed. At 5 years, 100% of the gains are not taxed, just as before. And rather than having that $10 million or 10 times the basis cap, that's been increased to $15 million or 10 times the owner's basis in that stock cap. So meaning if you had a company that the greater of was $15 million in gains, you sell it after 5 years of it being a qualified small business stock, you pay virtually no tax. It's really impressive. Also, some cool stuff is when you're issuing the stock, when you're getting all this set up, the asset limit got increased, where you used to only be able to put $50 million in. Now you can do $75 million. And both that $15 million number and that $75 million number are indexed for inflation, which I love. That's really good. So wonderful, wonderful, wonderful exit strategy planning. This is why we always say do that exit strategy planning early, so you can be able to take advantage of these different rules and things that we have. So deduct. Again, if you missed our episode last week, be sure to go on and pull up that episode, www.kennedy-financial.com, and listen to us each week on Life Planning 101. We're always trying to bring you education, information to empower you to make wise decisions about your future so that you can continue to live life on purpose. Thank you. God bless. Have a great week, and be sure to join us right here next week on Life Planning 101.
Thank you for joining us for Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services. If you have questions, you can email them to lifeplanning@kennedy-financial.com. Don't forget to learn how our sister company can assist you with all of your tax and consulting needs. You can find out more at briscoeandassociates.com. Be sure to tune in next week for more Life Planning 101. The opinions expressed herein are those of the firm and are subject to change without notice. The opinions referenced are as of the date of publication and are subject to change due to changes in the market or economic conditions and may not necessarily come to pass. Any opinions, projections, or forward-looking statements expressed herein are solely those of the author, may differ from the views or opinions expressed by other areas of the firm, and are only for general informational purposes as of the date indicated. Securities offered through Calton & Associates Incorporated, a registered investment advisor, member FINRA SIPC. Investment advisory services offered through Smart Money Group LLC. Kennedy Financial Services and Smart Money Group LLC are separate entities and are not owned or controlled by Calton & Associates Incorporated.